class. We hope you've had the ability to join us for weeks 1 through 3. No worries if you're checking us out for the first time, if you're attending one of these sessions for the first time. We usually spend a minute or two and just bring everybody up to speed so we're all more or less starting on the same page. I'll go ahead and just share quick disclosures that we have to keep up for a few seconds here. But the theme of this class, again, this is a beginner class. We talk about the basics, right? We talk week 1 about what to trade. We talk about stocks, bonds, ETFs, mutual funds. We set some very early on definitions of the differences in these asset classes, their characteristics, their risks, etc. We talk a little bit about research and methodologies, research methods, if you will, fundamental analysis versus technical analysis. There are differences to these approaches. There's pros and cons of both. Some traders are avid users of one approach, for example, technical analysis, whereas some longer term investors might seem to lean a little bit more on fundamental analysis. And then again, some might use a hybrid of both approaches. I think there can be some merits to using a mix of both approaches. So before we get started, we'll go ahead, just make sure you know what we do as a team, some of the resources we provide to you as a client, and the value we can add to your experience here at Fidelity, because that's really what we're trying to do. If you're somebody that's interested in trading, you're learning how to trade, these sessions are meant to be helpful to you. We're not here to say, buy this, sell that. We're more here to engage you, to help you with some of these basic educational roadblocks in terms of how do I enter a trade, and what are some of the risk rewards of trading, and what might I trade, and what are some Fidelity tools. Again, that's really what we're doing here. So again, if you're joining us for the very first time, just a reminder, you can access all of our content. If you go to News and Research, you can go down to where it says Learn. This is the Learning Center. Maybe you just want to call it Learn. Whatever the case, you'll see the landing page. Periodically, there'll be an interesting article. Maybe you want to click here, learn more. There's a lot of different articles covering a plethora of different topics. However, if you want to, again, access our content, you can go to the left-hand side here under Events. You'll see a couple different links. Trading Strategy Desk Coaching. This is our page where you can see a lot of the different topics that we cover. We do have recurring monthly classes that recur every single week. Each month is a 4-week class. There's about 5 classes that we do, again, on a recurring, each month. So if you miss one, you can join us next month. These individual sessions are not recorded. You'll see in the upper left-hand corner, it'll say that it's being recorded. That's going to be for quality assurance. That's going to be for compliance purposes. So each of these sessions will be a little different. So again, you'll have access to the slides we're going to share today. We're going to cover some homework in just a moment here. But again, sometimes there's nothing wrong with maybe attending the same class once or twice, just to make sure some of these concepts sink in. We do have every market day, and we certainly hope that for all of you watching today, you had a good Memorial Day holiday weekend. Monday or yesterday was a holiday. The market was closed. So we didn't have any sessions yesterday. But every trading day, when there's not a holiday and it's a regular market trading day, we do have these market briefings, which can be a great way to stay plugged into, hey, once you learn how to trade and you really understand a lot of these tools, a lot of these more advanced concepts, maybe you want to stay up to speed. What are people talking about? What are traders looking at? What are some key levels in the S&P? What are some stocks that are announcing earnings, macroeconomic events, etc.? We talk about all of these in these different sessions. So we certainly encourage you to attend that if that's going to be helpful for you, again, to stay plugged in, generate ideas, hear different perspectives. Again, that's all for your benefit as a Fidelity client. So with that out of the way, again, take a look when you get a chance. We hope that you'll join us for some of our other coaching sessions. We, again, do the briefings, which are very, very popular. It tends to be one of our more popular attended segments. We do have a whole slew of different options trading educational content. We do live demos of many of Fidelity's tools. There's a lot of tools that are changing. There's some new tools. So perhaps there's a tool you like that you haven't seen before. Go ahead, and if there's any other comments or questions you have today, there is that question and answer chat feature towards the bottom of your screen. We want to hear from you. We want to hear what tools you like to see. If you have questions today, again, that's part of the main value of attending some of these sessions. And in addition to what we're talking about today, there's some other sessions you can attend that if you're, again, a beginner to trading, or maybe you're simply doing some review in terms of what other types of sessions you've covered before, or some of these, again, knowledge gaps. We do have, again, a lot of other beginner type content. We have really beginner, intermediate, and advanced level content. So a little something for everyone, I like to say. And perhaps you want to build some of your technical analysis, knowledge and expertise. We do have a lot of sessions on that as well. So with those out of the way, again, if you go, I'm going to go back here just a moment, events, trading strategy desk classes, and you'll see we are in the trading basics class. You can go ahead, click learn more and register. This will take you to, again, the classroom page. You can go ahead, register here. You can open the slides that we have that we're going to show today as part of our discussion on some of the theoretical aspects. We'll also have some time to do a little bit of demo. If there's any ticker symbols you'd like us to use, we might show a chart. We might show, we're going to be talking about stop loss orders and some other things today. So again, if you, we'll have some time, hopefully, for some demonstration. So feel free to put those in. So if we click on learn more and register, you'll get to our, each month's classroom page. And again, we've discussed the what to trade, stocks, bonds, ETFs, mutual funds. We talked about the research and analysis, fundamental and technical analysis. We talked about how do we physically enter a trade once we've done our analysis, which in my opinion tends to be the hard part. The physical clicking of entering trades. You want to be comfortable with this, especially if you've never entered a trade before. This should be the easy part, in my opinion. So we covered that last week. This week, we're going to talk about managing risk. So essential to trading. I would say arguably the most overlooked and the most kind of brushed off aspect of trading, that arguably could be potentially the most important aspect of trading. So before we get started with today's content, Chase, why don't you go ahead and get us started? Let's take a look at the homework for week 3 so we can bring everybody up to speed with what we're going to cover today.
Awesome. Yeah. Thanks, Troy. Definitely happy to be here. Welcome, everybody. For those of you who celebrate or have maybe a chance to relax this weekend, I hope you had a good Memorial Day weekend as well. What I want to do, Troy, real quickly as we prepare for today's session, you did briefly mention the fact that we record these sessions, but typically they're just for compliance purposes. We do have a set of recordings that are actually available on the website, so I do want to cover that just real briefly here. So the way that you do this, folks, is on fidelity.com. Anywhere on the website, particularly up in the top right-hand corner, if you search in this little search box and you type in trading basics, what to know. I know it sounds oddly specific, right, Troy? But the system that we're using has been recently updated with our online library. So sometimes you had to type in the exact thing to find what you're looking for better or for worse. So type in trading basics, what to know. And when that loads for you, click on the second link, trading basics, what to know before getting started. And if you click on that, it's going to open up a new tab. Troy, the reason I point this out is it's going to have 4 weeks of recorded content that our team has already done. So they won't be these sessions or the last 3 that you've done with the class here, but just general sessions we recorded in the past for replay. So you can access these anytime. You probably have like 2 or 3 hours of content here, as well as the slides or the transcripts that were used. So for anyone, I saw a Q&A comment that came through a little bit earlier from Kim saying, hey, I missed a couple sessions. Do you have any resources? Yep, we do. This is the recordings in addition to everything Troy just mentioned. So I did want to just cover that real quickly here. Okay, let's hop into the homework itself, Troy, like you mentioned, where to find it, how to navigate to it, et cetera, et cetera. So week 3 homework. I've already gone ahead and highlighted the answers just to expedite this process. We can focus more on covering today's content. So question number 1, this feature allows you to borrow against the value of the securities you already own in your brokerage account. Definitely not a bond, definitely not a mortgage, and a HELOC, home equity line of credit. Those would not be correct. So the correct answer is C, margin. So margin is the feature that brokers really offer within trading accounts, non-IRA or non-retirement accounts. Another way to say is taxable accounts, for you to borrow, leverage your account to make trades that you may have otherwise not been able to make with the cash that you already have. So margin, that is going to be the answer. Number 2, what are the following risks of trading margin? Well, I mean, kind of generally the risks of using leverage in general, right? So you can amplify your losses, and that's going to be a major risk. You can be subjected or subject to margin calls or liquidation of securities. So think about, COVID 2020 pandemic sell-off or Volmageddon or, the 2007, 8, 9 kind of area of time frame where if there's a very substantial movement, you may be forced to liquidate a position even though you don't want to. So that's going to be a significant risk. And of course, losses greater than the original investment. Well, your investment could go to zero in theory, and you still owe what you borrowed to Fidelity. So that's a double, triple whammy, if you will. So there are certainly risks. Keep in mind when it comes to the financial landscape, there's always that balancing act. Like, hey, I can make more money with margin. Yep, that's true. But you can also lose more. So it's that balancing act. Okay, number 3, true or false. If you place a market order at 5 p.m. Eastern time, it will be, and this is the keyword, executed in the after hours session. That is false. You can absolutely place an order after market close. It could be 4:01 p.m. Eastern time. It could be 8 o'clock p.m. It could be 10 o'clock, right? Doesn't matter. You can place a market order anytime after market close. However, it's not eligible to be executed, or it's not executable, if you will, till the next business day at the market open. So yes, you can place a trade, but it will not be executed specifically for a market order after market hours. That's what this question is kind of testing, if you will. Okay, number 4, if you want to buy a stock or ETF at a price below its current trading price, which order type would you place? It would be C, a buy limit. A limit order, when you're buying, says, hey, I want to buy at this per share price or cheaper, right? So if a stock's at $100 per share, you could say, hey, I want to buy that stock, but only if it's $90 or less. So the market has to come down to you. It has to decline to a price lower than current market prices to execute that trade. Okay, number 5, true or false. A good till canceled order is good for that trading day only. That's the keyword, only, and will cancel out if not executed. It is false. A good till canceled order, if not executed, will be on file for 6 months or 180 business days, or until you cancel it. So it's going to be in effect for months and months and months, or you cancel it, or it executes. So good till canceled mean that order, hey, that's good till canceled, or executed, if you will. So that is false. All right, number 6. We'll come back to this in just a moment, which is, excuse me, how to look up a quote online or on ATP. So we'll get to that in just a moment. Which of the following would reflect trade price? Ask that you can buy at. Which of the following would reflect a stock that you can sell? Bid. And Troy, maybe just talk to us real quickly about that bid and ask. Like, why are those different for traders? Like, what's the important there? Do you mind just talking to us about that just real quickly? Some clients get confused.
Yeah, absolutely, Chase. Again, we looked last week at quoting a stock, right? So when we see these quotes, we want to really know what these quotes mean. I like to use analogies. One of the analogies is the market's an open a bid offer system, bid ask, and we like to use the example of maybe a house, right? When a house is for sale, people say, "What's the asking price?" And so if you want to buy, you need to put in a bid and see if the seller accepts your bid. Sometimes in a somewhat buyers friendly market, you can put in a bid that's a little bit lower than the ask, and the seller might be willing to have a little wiggle room. Conversely, and this is probably, again, I'm not a homeowner, not a home buyer right now, I hope to be at some point soon. I've heard that a lot of homes are selling either at or above their asking price. And so there tends to be less available. So you got to really give the sellers what they're looking for. So that ask price is the lowest, most competitive price that a seller is willing to accept. And then that bid price is the highest, most competitive bid that somebody else is willing to give you if you're looking to sell. So if you're looking to buy quickly, usually the price you're going to get is the asking price. If you're looking to sell quickly, usually the bid price is going to be the price that you're going to look for. You can always use a limit order to say, hey, I want a price. If you're a buyer, you want to ideally get the lowest price. So you can put a limit order below that ask. Conversely, if you're a seller, you want to typically try to sell at the highest price you can. So you could put a limit order above the bid. You might not get the price that you want, but what's nice is that if you're not super competitive, if you're patient, that limit order might be more helpful. Whereas that market order, again, the market changes second by second. That's how the stock market works. It's not as slow as, say, the real estate, or perhaps you've been to some kind of auction event. So that bid price is usually what you're going to get. If you're a quick seller, use a market order. That asking price, again, is going to be likely close to that buying price you're going to get if you are a market order for if you're a buyer and enter a market order.
Awesome. Thanks, Troy. Yeah, I think a lot of clients sometimes get that mixed up. So I think it's worthwhile to clarify. Okay, awesome. So number 6, so I'm going to hop into Active Trader Pro for just a moment here. Number 6 was asking to look up a quote for the stock or ETF of your choosing. In this case, we're going to pick on Apple for demonstrative purposes, and identify the page shortcuts that would link to a trade ticket. So over here on ATP, I've clicked on the quote box, and here's the quote. And I've opened up a positions box. So this lets us see any positions in the account. And the trick here, kind of what the question is asking, is where do you see these blue hyperlinks? If you see one, you can click on it. It's going to pull up a trade ticket with the details filled in for you. Okay. So if you're on a positions page, notice the bid and ask, as we just talked about. You can see those right there on the trade ticket, or on a positions page. It will link you to the trade ticket. Now, you've probably had some exposure with ATP up to this point, so just note that you can right click, and if you're on a tool, you can always hit buy, sell. Either one of those is going to pull up a trade ticket for you, so no problem whatsoever. Okay, Troy, that is all the homework for the week that we have planned. I know we've got some slide decks and some content to dive into. So while you get that ready and pulled up, I was thinking about this session. So I prepared just a little excerpt to read, if you will. This is from the CMT, the Chartered Market Technician Curriculum Level 1 2022 book, just to name my source. Okay. And this is from chapter 42, called Being Right or Making Money. And this is an excerpt from a book that Ned Davis wrote from Ned Davis Research. So it only should take me about a minute here, but I think this is worthwhile. It really sets the tone for today's class. So bear with me while I read through this, just a very brief paragraph. So Ned Davis goes on to say, and I quote, "The only problem was that at the end of the year, I would total up my capital gains, and unfortunately, I would not owe much money to Uncle Sam, right? Didn't make enough profits really to be taxed on. Before someone else could question me, I asked myself, if you were so smart, why aren't you rich?" By raise of hands, anyone ever asked themselves that question? I know I have. Troy, you too? Okay, continuing. It was about that time, 1978 to 1980, that I began to realize that smarts, hard work, and even a burning desire to be right were really not my problems, or the solutions to my problems. My real problems were a failure to cut losses short, a lack of discipline, and risk management, letting my ego color my market view, which in turn made it difficult to admit mistakes, and difficulty controlling fear and greed. It was thus a lack of proper investment strategy, a good money management techniques, not poor forecasting, that was holding me back. And when I read that, Troy, I just thought, you know what? That probably pertains to everybody, not just me, not just you, not just our clients, right? It's not our ability to forecast. It's not just, hey, I think the stock's going to go up. It's, do you have proper investment techniques? Do you have proper risk management? Is your ability to close a trade early, even if you're losing, or your inability to, is that stifling maybe your trading success? And the answer is probably. I know it has for me at times, right, Troy? I'm sure that you're in the same camp too. So just a little excerpt from the book. I thought that kind of set the tone for today's session. Like, why are we talking about this? Because the largest, 100 millionaires, billionaires, technical analytics firms, mutual funds, hedge funds, they're doing what Ned is talking about here, Ned Davis, risk management. Yes, you can be right. You're going to be right eventually. But what do you do when you're wrong? That's really the question that we want to ask and maybe focus on here today. So Troy, I'll pass it back to you now. That's a long-winded introduction. Let's hop into today's content, focusing on risk management and maybe keeping that little thought in the back of our mind of, hey, yeah, we are smart. We're capable. We've got all these computers and technology, but why aren't we gaining more money then? Why aren't we just printing money in our bank accounts? There must be something else. And risk management is probably that something else, huh?
Yeah, Chase, I love the quote. And really, this is one of my most favorite topics because, again, it's so overlooked. And perhaps you've been out there, maybe you've Googled, how do you make money in the stock market and what stocks to buy now? Everybody seems to focus on how do you make money, but tend to want to avoid the idea of how do we stop from losing money? Warren Buffett, to kind of add to your quotes there, Chase, I think that was a really great excerpt. Warren Buffett famously said, rule number one is to not lose money. And rule number two, don't forget rule number one. And so the analogy I like to use is a sports analogy. Managing risk is playing defense. If you don't play defense, you better have a crazy, crazy, crazy good offense. And even if you do, it's going to be very hard for you to be successful if you just let the other team score. And so, another analogy that our colleague Andrew likes to make, which I think is spot on, is a gardening analogy. We need to cultivate and allow our flowers to grow, and we need to cut our weeds. But what a lot of traders end up doing is they end up cutting their flowers and they end up with a garden that's full of weeds. And that's the opposite of what we want to do in trading. You've probably heard that, hey, markets are really hard to time. You shouldn't even try to time market. We talked a little about this in week one about the do you even want to trade? And there's really three things you need for trading. You need the desire, you need to want to do it, you need the time. If you're a busy working professional, you may not even have the time. You may be great at it, you just may not have the time. And you need to have the ability. So if you don't know what a stock is, if you don't know, okay, you guys are talking about managing risk. What does that mean? What are some techniques? We're going to talk about that today to try to eliminate that, again, that education or that knowledge gap that potentially could be keeping you from being successful. So as somebody who's been trading for well over a decade, Chase, I know you've been trading well over a decade. We are telling you right here today, if you're saying, guys, like get past the managing risk and tell me how to make money in the stock market, we are telling you right now, this is a very important topic and it cannot be ignored. If you want to make money, risk management is going to help you keep it. If you make money and then your next trade you'll lose it again, that's not going to help you, right? So we need to have a plan to manage risk. Managing risk helps us again keep those profits. It can prevent us from falling prey to some of these psychological traps. You mentioned Chase, fear and greed, I believe in that quote. And there's other things. There's a whole aspect of behavioral finance where we do things called loss anchoring, bargaining. It's sort of this psychological concept of denial. It's very kind of similar. But again, we're going to talk about managing risk. We need to have an exit strategy. Perhaps you've seen one of those spy movies, and what does the main spy always do, right? They go into maybe some shadiest establishment, or they go in some area where they're going to have a fight. They always look to the exit first because if things get dicey and they need to make their escape, they need to know where's the closest door. I need to have a clear pathway to the exit in order to make a quick and expeditious escape. We need to monitor our positions. Once we make a trade, there's a lot that can happen between the time we open a trade and the time we close it. And again, there can be a lot of ups and downs and volatility, and different styles, different techniques are going to help us have a better likelihood of being profitable as a trader. So let's get into it. If we go to the next slide here, here's some things to consider. And then, Chase, I'll definitely welcome some of your thoughts. We want to talk about volatility and what is volatility. Sometimes people think, okay, volatility is when my stock goes down, and that's only about half true. Volatility refers to ups and downs, right? Once we learn a little bit more about some of these advanced techniques, we can actually trade different directions in a market. We can trade a bullish direction, right? We think a stock or a security is going to go higher. We can trade bearish direction. We think the stock or the underlying security is going to go down, and there's different techniques to doing that. Now, one of the oldest and kind of basic ways of trying to, reduce volatility, again, volatility are the ups and the downs, is this idea of diversification. Now, I like to present something. I also like to be a little bit cynical and present the other side of it. So when we're talking about diversification, you may have heard the adage, hey, don't put all your eggs in one basket. I think that makes sense, right? If you take, and perhaps some of you have been at the grocery store and you literally picked up a carton of eggs and dropped it, a lot of the eggs are going to get broken, and now you're stuck with a carton that's full of broken eggs, and it's not going to do you good, especially if the prices of eggs have gone up. So the idea is, okay, maybe we buy a couple smaller cartons. Therefore, if I drop one carton, I still have some other cartons full of eggs that are not broken. Now, this can help, right? If we think about diversifying in week one, we talked a little bit about the differences in asset classes. So we can diversify through a bunch of different perspectives. We can diversify by asset class. What's an asset class? Well, stocks are one asset class. Bonds or fixed income are another asset class. Commodities are going pretty crazy right now. We're going to be talking, I'll be in the aftermarket briefing. We're going to talk a little bit about silver and some of these other commodities that are having a little bit of volatility here. So commodities are another asset class. Some might say real estate is a separate asset class, although if a stock is a real estate stock, maybe it's again sort of a multi-asset class type of a deal there. We can also diversify among sectors. We talked about that in week one as well. A stock could be in the financials sector. A stock could be in the technology sector. So we can diversify among asset classes. And then within the asset class of, say, just stocks, we could diversify among sectors. We could diversify among market capitalization. So we could invest in a very large, well-established company. We could invest in a small company. They're going to have usually different profiles. Some companies are more growth. Some companies might be more value oriented. There can be times where certain types of stocks become more favorable to certain investors based on certain aspects of what type of market environment we're currently in. Think about geography. Many large, well-established companies are multinational, so they have operations in different countries. Perhaps you've seen stuff on the news where, hey, there's a a tsunami that hits Japan or that hits Taiwan or hits parts of Indonesia. Maybe you have a company that's headquartered on the East Coast, right? Maybe somewhere south near Florida or some of those other states that are a little bit more privy to hurricanes. That's just one basic risk, which is environmental risk of a storm, a tsunami, something like that. So if you're investing in just different areas of the world, you're kind of diversifying or sort of hedging that natural disaster or climate change risk, whatever you'd like to refer to it as. And then again, there's different style companies talked about growth, value, income, dividends, growth. There's pros and cons. Now, diversification is not a perfect way of taking away risk. And some might be cynical and look at diversification and say, diversification, more like diversification. And if you spread your money out in many, many different places, well, that can be good. But what if you're spreading your money out just for the sake of spreading it out and you end up buying certain areas of the market that potentially aren't even really attractive? So diversification is a good idea, right? Have a bunch of different horses in the race. But the idea is sometimes don't necessarily spread your money out just for the sake of spreading it out. We don't want to just buy things that are bad or investments that aren't doing well or don't meet our preference just so we can say, hey, they're spread out. We can spread our money out in different ways. So, for example, if we like one sector, well, one way to spread our risk out is we can buy a couple different stocks within that sector as opposed to putting all of our money in one stock. If there's certain sectors we don't necessarily like for whatever reason, we don't have to buy that just so we can say, I'm diversified. So again, spread our money out across many different places, but not necessarily buying something just for the sake of buying it. Position size and Chase, I'm going to definitely welcome your thoughts here in a minute. I think position sizing is one of those very basic, essential ways of managing risk. If we, again, I like to think of extremes. So the extreme is, hey, put all of your money in one stock. That's incredibly risky. And that is, in my opinion, that's really not a good idea because if that one stock, let's say a headline comes out tomorrow, let's say Murphy's Law, where they end up being the next Enron or they end up being the next Blockbuster, that could happen. The probabilities, I'm sure, is very low, but that always can happen. So just by buying an index or by buying a couple different companies, you're really removing some of those very low probability, but very detrimental risks. And again, when we trade smaller or we have proper size that's proportionate to what we're trying to accomplish, this can make it easier for having an exit strategy. right? So we talked about, the top little bullet point there is volatility. If you put all of your money in one stock, let's say you're bullish on the stock and you buy a lot of shares. Now, even if you're right, let's say between now and let's say in a month, the stock goes 5, 10% higher. Well, if you're all in, wow, 5, 10%, that's great. If you make that in a month, now, let's say before you were right, before you get to about a month where it goes up about 5 to 10%, let's say it goes down a little bit first before it bounces. Well, as it's going down, you're going to get nervous. You're going to start to sweat and say, oh, maybe this thing isn't working out. And then maybe you sell the stock, you bail, you realize a loss, and then the next week you see the stock bounce back and go higher. You were actually correct, but because your sizing was too big, it made you nervous and you weren't able to tolerate the volatility to kind of see your investment through and see the hard work that you did to actually that you were correct. There are going to be times that that happens, right? There's going to be times that, hey, it's just not working out. I need to bail, and there's nothing wrong with that. But we don't want to trade so big where at the first even sniff of trouble, we're gone without actually giving it a chance. And sometimes we might need to give our investments a chance. Proper position sizing helps us to give it the benefit of the doubt and we tolerate a little bit more volatility before we see some kind of outcome that's going to help us determine, okay, this trade really working out. Let's stick with it. Let's let it run versus, hey, this is not working out. Is it better to wait and see if it turns around, or am I better off cutting my losses and putting my money perhaps to better work somewhere else? So position sizing is huge. We're going to talk more about that. We need to have an exit strategy. It should be defined. Hey, here's where I'm entering. Here's where I know I'm wrong. Maybe that's a certain level in our technical analysis class. We talk about support and resistance, which is huge in charting and technical analysis. And whatever our style is, and folks, I want to really encourage this. There's many different styles out there. Some will ask us, and Chase, I'm sure we get this question that how do you trade? What's the best indicator to watch? And there really isn't one necessarily methodology or way of trading. You can be a buy low, sell high investor. You can be a buy high, sell high, very short-term momentum trader. And both of those have merits to where they can make money. But it doesn't matter what your style is. You need to have some method of playing defense and managing risk. So that's really the driving home is it doesn't matter what kind of trader you are. You need to have processes in place to manage risk. And when you're consistent with your process, maybe use a couple different styles. Maybe you size saying, hey, the stock is going to be 5% of my portfolio, 10%, whatever. It's going to help you be consistent and track your progress and say, okay, I need to make small tweaks here. And that can help you refine your process as opposed to just throwing trades out there willy-nilly. You need to have a plan in place, and that's going to help you, again, have the highest likelihood of being successful. So, Chase, why don't you talk to us a little bit more about position sizing? Maybe you want to share some of your thoughts on managing risk. Maybe you want to share, again, some things that have been helpful for you, some things that have been kind of that aha moment.
Yeah, yeah, of course, Troy. And I had one thing I wanted to add when it comes to maybe the diversification comment you'd made earlier too. A lot of folks are, I would say, maybe not as diversified as they think they are, right, Troy? Uh, who here is invested in the S&P 500 just by a raise of hands, right? We got about a couple hundred people here with us in the class today. So if you have a mutual fund, an ETF, right now I've got SPY, which is the first ETF created, which tracks the S&P 500, but it could be a Vanguard fund, could be whatever, right? What most people don't recognize necessarily is that it's not equally distributed amongst the 500 companies in the S&P 500. The top 10 companies, now this is the ETF, not the true index, but it's going to be very, very close for conversation purposes. The top 10 stocks make up almost a third of the entire S&P 500 by the distribution, right? By the sort of weighting of these holdings. And from a sector approach, information technology itself is almost a third, right? So if you're someone who's saying, hey, I'm diversified, I own 500 stocks by purchasing an ETF or maybe by a mutual fund, potentially, yeah, but you're not equally weighted across those 500. So just kind of keep that in mind. I always like to point that out to clients. I know we probably talked a little bit about this here, Troy, in week 1 or 2 when it comes to investing basics, but yeah, just noteworthy. In addition to that, we had a comment from AP saying, well, isn't Warren Buffett maybe not as diversified as you think? That's absolutely the case, at least from what I've read, what I've reported or seen reported, is there's a mindfulness and an intention to not be diversified. The difference, though, is that Warren Buffett, relative to maybe us mere mortals down here, is really getting on the board of these companies, is more controlling. I don't mean that in a negative way, but he has the influence to control the direction of the business. So he's not really buying them as like a stock position. He's buying them as a business to be an investor to either actively or passively manage it, right? So it's a little bit of a different approach. Just like if, Joe's coffee shop down the street is like, hey, AP, I need a $50,000 investment, and you'll be like a board member, or I'll make you a silent partner of the business or whatever. That's a very different thing than trading or investing in a stock market. You really are more of a business person than an investor, and maybe in the traditional sense. So yeah, there's a lot of ways to go about this for sure. Warren Buffett certainly has their own process. Couple other questions that came through as well. So John saying, is the Dow also market weighted, or is it equally weighted? So the Dow is actually going to be price weighted, which is even maybe stranger, right? So this is market weighted, the S&P 500. So the companies with the biggest market cap get more weighting than those with smaller caps. The Dow 30 is price weighted. So the company that has a higher price per share gets a higher weighting. It's not really focused on the market cap. So there's all these criteria, but for using an extreme example, you could be a relatively smaller company compared to the other, let's say 29 components within the 30, but a very, very high price. And that can sort of change the weighting in a way that most people would be like, huh, what? But it's price weighted. It's not going to be market cap weighted. So even that is not going to be equally weighted. Now, there are indices that we can chart on Fidelity.com and ATP that are the equal weighted versions. I just want you folks to understand this. Like if you own the S&P 500 and you're talking to your in-laws, your cousins, whatever, at next, family gathering, and they say, hey, what are you invested in? If you say the S&P 500, just recognize, yes, you're in 500 companies, but maybe not equally in terms of the distribution. Just something to point out when it comes to risk, right? If Apple, Microsoft, and NVIDIA have a bad day together, right, that's about 15, 16% of the S&P alone. So if you might say, hey, why is the S&P down, but most of the companies are up? Well, yeah, but the biggest ones are the most heavily weighted might be down, for example. So that can also be a risk factor when it comes to trading. Okay, Troy. Let me transition over now to position sizing. I think this is definitely important when it comes to the way that we approach each individual trade. So what I've done here is in Active Trader Pro, I want to keep this basic or as basic as I can, but there's a tool that we have. Now, again, I know we're not hopping into options. That's more of a different class that we host, but there is a tool called the Profit and Loss Calculator. Okay. And this is under the options dropdown. Now, what this lets you do is enter in hypothetical trades, which you can also do just pure stock, right, Troy? So we don't have to look at these option examples, especially if we're going to focus on the beginner perspective. What we can do, though, is look at a hypothetical position and then change what happens to price, time, and volatility. And what is the outcome? Now, when it comes to a stock, really focused on price. Maybe we can do some time just for our own mental analysis, but the price is the biggest factor here, right? So what if we go ahead and we buy, if we're long, 10 shares of SPY as just a brief example? I know most clients watching probably don't have capital for, 100 shares or a round lot, if you will. This is going to sound simple. This is just basic math. But what if the stock goes to 540? What does that do for us? Well, our profit or loss, if we bought at current pricing, is about 117 bucks. Okay, well, what if we were short the stock? What's our loss? About 117, 118 bucks. Why do I show this tool? Because let's imagine for just a moment it wasn't 10 shares, right? What if we decided, hey, go big or go home position sizing, we're going to sell short 100 shares. Well, now we've just lost $1,100 just like that. So what I always encourage clients to look at, we always think that we're okay with losing money, but we're really never, right? No one loves losing money. At least I don't. Try. I know that you don't either. So then the question is, well, how much money can we lose that's tolerable and still sleep at night? This tool is one of many. Again, it's not a whole tool demo, but I just use it as a brief cursory glance at this concept of position sizing. You can put in a hypothetical trade of 100 shares short, or let's say you're going long, 10 shares, 1 share, 50, 200, whatever the number might be. right? The industry standard of a round lot is 100 shares, but not everyone has capital for 100 shares of a stock. But put in whatever quantity you think you would invest in and then run some scenarios. What if you went long and SPY dropped down to $500 a share, right? Well, on 10 shares, I say only losing $280. But again, what if that was 100 shares, 1,000 shares? So I always encourage clients, if you're trying to debate position sizing, pull out a calculator on your phone or just use hours, right? You can use this in a tool. You add a submitted position and you can do an option trade or you can do a stock trade if you want in here. So I don't want to get too lost in the sauce in this tool, but it's worth noting that the size of your position will drastically change some of this math. If I hop into the slides for just a moment, like what are some of those other key considerations when it comes to position sizing? What I always try to, inform clients is that you don't need to have your whole position at the beginning of the trade. Now, what do I mean by that? This is kind of different, I think, for most investors, right, Troy? If you're a home buyer, you don't buy a half a house. Well, I guess maybe in this market, your money only buys you half a house, but per transaction, you're only buying a single house at a time, typically, right? But with stocks, let's say you want your whole position, your entire position to be 100 shares. You don't have to buy all 100 at one single point in time. You could buy 25 4 times. You could buy 10 times. The terminology is often referred to as scaling into a position. You're scaling in, you're scaling out. By a raise of hands, who's heard of dollar cost averaging? Raise them high here just so that we can get a note on the familiarity of such a term. Dollar cost averaging is just a different way of looking at scaling in and out of a position, right? Rather than putting all your money into a single trade at one point in time, which has some timing risk, you're going to spread out that investment through time. So whether you want to call it dollar cost averaging into a position, or conversely, you can do the same getting out of a position. Let's say you own 100 shares, but the tides are starting to turn against you. You might then say, hey, I don't know if I want to get out of the whole trade, but I probably want to get out of some of it. And so I'll take some chips off the table. Of my theoretical 100 share position, I'll sell 25. Why? Well, it's a reduction of 25%. It's just round math. Maybe each week, if the thing doesn't improve, I'll just get rid of half or 25, 25, 25 and dollar cost average out of the position. Why does this help traders, Troy? Again, from a psychology perspective, if we put in, let's say 25 shares in a stock, I'm going to hop into ATP and just do some live demo here. And folks, if you have a symbol, by the way, I meant to mention this earlier. If you have a stock or an ETF that you want us to use as an example, put it in the Q&A. This is definitely the time as we hop into maybe some of the application and just brief examples of these concepts. But let's say you're looking at something. I'll pick on SPY just since we're talking about it, right? Why is it important to start with a smaller position, potentially, especially if you're a newer trader? Because let's say you entered into an investment right here on this day. And let's say you did it on the close. Let me zoom in a little bit further here. You say, hey, it went down. I'm buying the dip and I'm expecting a movement up. And what happens? Next couple of days, it moves up. Let's say every week you buy 25 shares. Okay. So here's our day of initiation. 1, 2, 3, 4, 5th calendar day since we buy again. Well, if we want 100 shares, but we've only got 50 up to this point, we're buying 25 kind of once a week. Things are still looking, okay, right? We have some shares here, shares here. We're probably, maybe a little bit past break even, depending. Then what happens? Well, very quickly we get a red day. Like, ooh, that doesn't really look so good. I was expecting to continue higher and it didn't. Maybe I'll wait one more day just to see if it turns around. And what happens? Big red day. The difference here, though, Troy, is from a position sizing perspective. At this point in time, we only have 50 shares, not the full 100. So even though our loss might be a couple percent, it's only a couple percent of half of the position that we were expecting to have. We didn't get the confirmation we needed to get the full 100 shares, right? So just think about like dollar cost averaging. You don't want to necessarily start big because let's say you buy at the open and you have a massive down day. Well, that timing didn't really quite work out, did it? And we can think about this from an intraday perspective as well. If you buy all your shares right at the open, sometimes that works and other times maybe not so much, right? So we want to just be mindful of that. So dollar cost averaging in and out makes the psychology of taking losses a little bit easier because you're taking losses on a smaller trade through time. Diane says, I'm lost. What's the definition? So, good question. What's the definition of position size? So, position size is how big is your trade in a quantity. So, keep it with stock. How many shares of stock do you have? Do you want to buy 1 share of SPY or 100, 50, 200, however many shares that you want to buy, keeping it simple with stock. So, you can think about it as how many shares do you own as position size. So, my point, Diane, is, controlling how many that you start with. If you start small, if things get worse, you can cut your losses early and not really feel too bad about it. But if you go really big at the beginning and you buy a whole bunch of shares and things go bad, that makes it more difficult for you to really admit that you're wrong. And then things get worse. And then you still hold. And then you pray that things get better and they don't. That's how those large losses occur. Okay, back to the slides for just a moment here. And then I'll pass it back over to you, Troy, for the next section. What are some rules of thumb when it comes to position sizing? Or again, how many shares of stock do you want to own? Like, should you buy 10? Should you buy 100? Like, what's that number? Think about it this way. What's the cumulative or the total dollar of loss that you're willing to accept? There's some rules of thumb. Some of the rules are you don't want to lose more than 1% of your account per trade. Okay, so super simple math. Let's just say that you have $1,000 in your account. Well, hey, I don't want to lose more than 10%. So I got to keep that trade loss pretty small before I close it. And if I hit that threshold, I just close it out, move on to the next trade. All right, but you want to have that number sort of in mind before you go into the trade so you can start setting up a plan as to what you're trying to accomplish. Okay, Troy, I'll pause there for a moment. Any other thoughts that you want to share on position sizing? If there's an example that you want to use at a high level of maybe how this is useful to a trader.
Yeah, Chase, again, this is a big deal. So it's one of the simplest and it's one of the easiest and probably one of the most overlooked things to consider. So again, sizing, we're saying, what's the size of this trade relative to your whole account, right? If you have $100,000 account and you buy $10,000 worth of stock, well, that stock is 10%, right? It's, you just take 1 0, move it over. It's 10% of your portfolio. If you have a 10% stake in one stock, well, what if that one stock goes to zero? That means in theory, right, you can lose 10% of your account on just one position. Now, there's different stocks that are going to have different personalities. If we think about a stock, what's maybe a one stock that comes to mind that's super, super volatile, or you've seen it go up and down a lot? Maybe you have a name in your mind. Maybe you want to think of a stock that's gone up pretty, slow and steady. It's not as volatile, right? Even if it goes up, well, we can say volatility is the ups and downs within a short period of time. So if a stock just kind of steadily climbs, it's not volatility, really. It's just a steady, consistent climb. A stock that goes up over time that's more volatile will have, again, those ups and downs. So the idea is based on your analysis, based on your outlook, and based on that specific stock, because different stocks are going to have different behavioral, different, profiles, different personalities, if you will. There might be some stocks that are going to be more volatile. If there's a brand new tech stock that you're looking at and saying, this is a really interesting company, I want to invest this and I want to own it maybe for a couple of years, but it's really volatile. Typically, the more volatile something is, all else equal, if your risk tolerance is the same, you want to buy a smaller position. And if you think about the concept of, we talked about this a little bit in terms of scaling in terms of dollar cost averaging, you got to be careful because dollar cost averaging, think of, again, like your 401k or something like that. Dollar cost averaging is very frequently used in something like that, where you're buying a fund, like an S&P fund, like you discussed, Chase, or maybe a target date fund for your retirement. And the idea is, hey, I'm buying something that's very diversified. I'm just going to buy a little bit at a time. If you're doing that with an individual stock, you just got to be cautious because, again, when you're doing dollar cost averaging, you're slowly adding and increasing your position. So you want to ask yourself, okay, well, how big should my position be? I'll be honest, there's been times where I'm investing and I'm trading something that's pretty low volatile or has low volatility. I'll size it up a little bit more. There will be some stocks where I'm saying I got to give this thing some room because before I really know I'm wrong, there might just be some volatility that's normal, right? So I want to give it a little bit of room before I really know that I'm correct. Let's use a little bit of example. So I'm going to go ahead, just grab the screen and show my Active Trader Pro here. And let's just use an example of, for example, Microsoft. And there were some other ticker symbols that were asked, and I want to use those in addition in a moment here. But again, if you look at the stock maybe from its recent lows in October to where it is now, this was a journey of $315 per share to 429. That's an increase of about $114. Well, $114, that's like a 30 some odd percent return. That's a huge percentage return. We use our line here. Yep, it's about a 30% or so return. Now, again, you didn't get that return in a nice straight line. There was a little bit of volatility. If you were fortunate enough to buy right here, well, you made money pretty quickly, and all you really had to do was be patient. But what if you bought right here? Well, if you waited to the end, you got something like still got a 12 to 14% rate of return. That's nice. And you got that in about 6 months or so. That's not bad at all. That's actually very good. Now, again, you had to wait and see the stock pull back about 5% or so. Now, let me ask you, how big was that stock in your portfolio? Did you put all your money in Microsoft? Well, nothing's wrong with Microsoft. Microsoft's a good company, but you watched your portfolio go down 5%. And for some people, hey, 5% is nothing, no big deal. For other people, that might make them sick to your stomach, and you might get some, acid reflux, and your face might start getting flushed, you might start sweating a little bit. So different people are going to have different risk tolerance profiles. With risk, there's typically your ability to sustain loss, right? If you're somebody who's younger and you're investing for retirement or some longer term goal, you typically have a little bit of time to recover. If you're somebody who's in retirement or near retirement, you don't have that luxury of that extra time. So all else equal, you have a lower ability to sustain a similar percentage loss than somebody else. So when we think about losses, we can think about, or gains, we can think about nominal loss, right? Hey, I lost $100. Well, what's $100 to me versus $100 to you? Some people that could be a lot of money. For other people, hey, $100 is nothing, right? So you have to kind of think about how much risk is that in relationship to your overall picture? If you're a multimillionaire, $100 is not really much. If you've got $1,000 trading account and you're brand new to this, that's 10% of your account. So that's a huge loss, right, in terms of your portfolio performance. So again, you have to ask yourself, how much are you willing to kind of stick along for the ride? And again, it's going to depend on your analysis. It's going to depend on your entry point, your methodology. So it's a complex question. And so when we ask complex questions, we should get a complex answer. So sizing is important. I would say the newer you are, the lower your risk tolerance, really the smaller bites you should be taking. The bigger bites you take, there's a higher chance that you're going to choke. If you take a small bite, you're not as likely to choke. And if you make a bad trade, right? Let's say you bought a very small size of Microsoft. Even if you got out and your long-term analysis was correct, all right, maybe you're kicking yourself a little bit, but you didn't lose that much. And so, okay, lesson learned, maybe I should have given it a little bit more volatility. So again, when you are learning and developing a process, typically smaller is better, because after you've developed a process that you're comfortable with, and that's going to be your own, it's going to be different than somebody else's, you can always trade bigger and start scaling up. Hey, my winners are 3 times the size of my losers, and I'm right a lot of the time. That's a great recipe. You might want to increase your size to try to juice up your returns. But be careful if you start trading bigger and some of that discipline you were using when you're trading small, maybe when you're trading bigger, you get a little bit more nervous with those losses. You start cutting them too quick, you don't let it pan out. Or maybe the opposite's true, which we tend to see a lot, is where you start making a little bit of money and you don't give it that same percentage patience of letting your winners run. You take the profits too quickly and you cut your flower too soon, and then you let your weeds grow. So again, there's no one single way to kind of do this, but we want to make sure you're in the right headspace and you're thinking about size of losses, size to gains. So hopefully that helps with the sizing aspect. Chase, anything you want to add there?
Yeah, Troy, we got a couple of great questions in the Q&A. Folks, I know if it seems like we're spending a lot of time on this topic, there's a reason for it, right? Because if you go too big, things go wrong. That's how you lose a lot of your account value. But you go too small and things go right, you make some money, but maybe not as much as you want to. So there's a reason we're spending a ton of time here. Troy, let me just clarify real quick. I want to give a little bit of a further example for clients to use. Now, as a disclosure, folks, this is from a different presentation set that we typically use for a different presentation. But I thought it would apply to this conversation since there's so many questions on position sizing. Just to be clear, for my compliance folks out there, this is from a Plan Your Escape Having a Good Exit Strategy webinar. Here's the disclosures from this presentation slide. So what I wanted to point out is this is kind of the math equation that some people might use to what I call back into the position size. So what we're trying to do here, and I would encourage anyone at home maybe just to take a screenshot of this or just a picture so you have this available to you. But what we're trying to say here is what is the maximum risk I'm willing to take on any given trade as a percentage of my overall trading capital? You can think about this as your trading account. So again, let's say you have $100,000 in your trading account that you trade with. Well, a 1% loss of this is $1,000. Okay, so if you're saying, hey, the 100% loss of a single trade has to equal no more than 1% of my account. That's that starting place right here. Now that we know our risk per trade maximum threshold, which is kind of from this initiating point, then it's like, well, how many shares do I get? What's my position size? And what we do is we can kind of work that in by how much risk we want to take per share. So if I risk $1,000 total in a trade, but I allow it to go down $2 per share from the day I enter, then I can only afford to buy 500 shares. If I buy $1,000 worth of the same stock at the same point in time, but I'll give it more room to breathe, more volatility that I will allow in the trade, more per share loss I'll allow, but no more total loss, then I have to go smaller. So what I would encourage is, again, just take a screenshot of this, and we don't have time to go through every single permutation of the example, but the idea simply being is, just to have a rough rule of thumb, like, hey, if I have $10,000, do I really want to lose $5,000 in a trade? That's 50% of my account if I'm wrong. That's not going to be sustainable or tenable. So find some number that makes sense for you, right? And then you can use this equation, if you will, which is simply, hey, if I let the stock move less, I can afford more. If I let the stock move around more, then I can afford less, because I'm really trying to keep my risk under wraps. Hope that makes sense. Let me go through just some of the other slide content that I have here. And if anyone needs this again, let me know. I can pull it back up towards the very end. But yeah, NG, I saw your comments. I was doing my best to answer those for you. So I hope this kind of addresses what you're talking about. So back to these slides, what are some of the mechanical or tactical tools that Fidelity and really just the brokerage industry at large offers to you to maybe automate or enact these types of plans? Like, let's say you've done the math. Hey, I stock X, Y, and Z. I only want to risk and have a maximum loss of $1,000 for the trade. And I want to lose only $5 per share, which means I can only afford 200 shares. Well, how do I kind of execute upon this? Very, very commonly, someone's going to use a stop loss order. A stop loss order, you place it and it puts a line in the sand and says, if the stock goes beneath it, we'll sell it. Just like that. So we'll pick on an example. There's a few symbols that came through from our clients. We got Ulta, ULTA from Jennifer. So stock has recently pulled back quite a significant amount. Let's say that you bought it just most recently here. In fact, I'll go on an intraday basis. Okay. Let's say you buy it right at current pricing, 380. You might say to yourself, hey, I want to sell this stock no matter what. If it goes below, let's just call 379 even. We're going to pick on this, 379. Well, 379 is basically $1 or $2 away from where it is. So it's not really that far. But if it goes down beneath it, you want to sell it automatically. So that's at $2 per share risk. Okay. Then we just do the math and say, how many shares do I want? Troy, do you have an example of maybe how you might use a stop loss? Like what that means to you as a trader?
Yeah, Chase, again, last week we talked about market orders. We talked about a market versus a limit. These are the same type of orders, right? A stop loss order is a market order. So, if we're entering a trade, the stop is a trigger. It's a trigger that activates a market order. So if we say, all right, if you were looking at Ulta and let's say you bought at 400 and you said, okay, at 380, that's where I call quits and that's where I throw in the towel. I'm done. $20 per share. only maybe bought 100, a couple shares. Again, it depends on your size. If you bought one share, $20 per share, it's only $20 loss. Your loss can be small. So again, you can buy and you can, scale appropriately based on what risk makes sense to you. Now the stock is trading 380.81. I think today it looks like on your intraday chart there, Chase, it went under a 380. So what would have happened is if you owned it at 400, it came down to 380. Once it hit 380, that's a trigger, and now it enters a market order to sell. It's an automatic exit strategy. It basically says, hey, when the stock gets to this point, I'm automatically closing, and the system does it for you. You don't have to manually enter a trade. The trade is a trigger-based order, so it'll start there by itself. Now you have to ask yourself, do I want to automate my trading? Some people like to physically make that decision. And there's an important thing that we need to talk about, which is gapping risk. A stop loss order doesn't protect you from a gapping risk. For example, if a stock closes 4 p.m. Eastern and then it opens tomorrow at 9:30, and after the close at 4 p.m. they announced, hey, we just here's our earnings. We didn't do so good this quarter. The stock can open substantially lower tomorrow morning when the trading starts. And so the price could gap under where you're trying to get out. In this case, the market order or the stop would get triggered. You'd get out at the next available price. It could be quite a ways away from your stop. So the idea is, again, a stop loss is an automated method of exiting potentially an unfavorable position or a position that's going against you. Now, you could have a lot of gains built into the stock. Chase, some of the questions we got is, hey, Troy, I have a stock that's a big winning stock. Where do I get out? And sometimes that question can be just as hard as, hey, I've got a big losing stock. Where do I get out? There was an example of using something like NVIDIA. We all know that's been a huge winner. And thanks so much for using that ticker symbol. And so you might look at the stock here, and I'd have to ask yourself, people ask, hey, should I get out? Should I start selling it? It's made me a ton of money, and that's great. My question to you would say, I would ask, where do you think the stock is going from here? Do you think it's going to go even higher? Do you think it's going to maybe tuck in? Are you uncomfortable that it's going up very fast? That's a question really only you can answer. The easiest way to manage risk in any type of a trade is we can always close the trade. If you don't know how to enter the trade, you can call Fidelity. Somebody can assist you in placing the trade. We can always close a position. So we don't have to use a stop. We don't have to use a stop limit. A stop limit is another trigger order, but it becomes a limit order as opposed to a market order. We talked about that last week, so I'm not going to kind of hash that. But again, a stop might be useful to you because some people might use a stop right at the onset of their trade. They might say, hey, I'm going to buy at $100 a share and I want to automatically get out $80. Doesn't matter what the news is, doesn't matter what the situation is. If it hits 80, I'm out. And that could be helpful for some people. You know, again, some people might not say, I might not want to automatically sell. I might want to, 80 still might be my exit, but I might want to have more of a soft exit where if it hits 80, I'm going to wait and see if it trades. And if it kind of bounces really quickly, I might give it some time to see if it can recover versus if it hits 80, I might wait to see, and my hard exit might be 75, and maybe I might manually place a trade at 75 as opposed to automatically getting out at 80. There's pros and cons of different approach. So there's no right or wrong answer. Our goal is to make sure you're aware that, hey, there's different options, there's different styles. So you can have an automated exit, you can have kind of a soft exit. I would say, regardless of your approach, you should have usually an area where, hey, if the stock goes here, I'm out. Questions, no questions asked, I'm done. Now, again, that's kind of an idea. You could use something like sizing to kind of circumvent that way to kind of use that strategy to manage risk. For example, if you buy really small pieces of stocks, you might have the luxury of watching it go to zero. So you might just say, hey, I'm just going to buy it. And if it doesn't work out, I'm just going to keep holding. That's not really the best way to look at it, probably. But if you buy a really small chunk relative to the size of your portfolio, that might work for you. If you buy 30 stocks and they're each 1% of your portfolio, well, that's only 30% of your portfolio, by the way. What are you doing with the rest of your portfolio? But again, if you're using sizing, that might be a way to kind of give the stock room. There's probably a happy medium. You probably are not going to want to watch a stock go to zero. Another method is, Chase, as you're showing here, a trailing stop loss. This is again another one of those automated exit points. The difference here is a stop has a stationary trigger. This, think about walking down, and Chase, feel free to kind of chime in here, but a way is perhaps you're pulling, again, for lack of a better phrase, maybe you're pulling a brick with a string, right? You have a brick, it's attached to a string, you're walking down the sidewalk. When the all the slack is taken out of that string or that rope, you're going to pull the brick. Now, if you start walking back towards the brick, you're not pushing the brick away. The rope just, the slack comes out of the rope. And so it's the same thing with a stop, is once it moves closer to your price, it's not moving back. And so if the price retraces, that trigger is going to order. Now, if the stock keeps going higher, this is kind of a modified stop where if the stock keeps going up, your stop is trailing the stock. So you potentially could continue to profit if the stock goes higher, but there's some methodology of saying, hey, I don't want either a nominal retracement or a certain unfavorable percentage retracement. Chase, any thoughts on a trailing stop loss or a trailing stop limit order?
Yeah, pretty commonly used by traders who want to let their winners run and have a little bit of like a hands-off approach, a bit of a set it and forget it. Without going too far into any one particular technical indicator type rant, Troy, I've done my very best not to go down the weeds. A very common indicator that I think helps just the visual aspect of this get through to clients is something called the PSAR, the parabolic stop and reverse. You go to indicators, you just type in PSAR, PSAR. This is really meant as a sort of holistic or an all-inclusive trading system, but just for, I think, educational purposes, it kind of does a good job of indicating what a trailing stop loss might look like. I should just disclose it's not exactly the same. It has like a parabolic or a sort of exponential factor to it. But the idea is as the stock goes up, the order itself, you can think about the order as these dots, is going to be adjusted with it. But notice they never go down. They might stop at a certain level and go straight, but they never like retrace, if you will, from the initiation of when they start. So it starts here, goes up, 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 up. It might just go a little bit to the side, but they never go down. So the stop loss or the trailing stop loss order, excuse me, won't adjust downwards. So pretty advisable for clients who say, hey, I'm going to buy some stock, maybe it's NVIDIA, and I'm going to let this thing run. I also don't have time every day to watch this thing, but if it just absolutely takes off, I want that order to kind of adjust with it. So if it does have a quick retracement back down, I can lock in some of those gains. So yeah, trailing stop losses are very, very common for traders. Okay, I want to talk just very briefly here as we're coming towards the end of the session here, Troy, about some key considerations for clients. Our slide deck talks about technical analysis for exits. Myself, and I know even for you, Troy, many of our teammates on the trading strategy desk, we tend to be more technical oriented as traders. Because really, if you're trading, you need data that's pretty frequent. And by definition of fundamental analysis, which is typically coming out as quarterly earnings, you're only getting data once a quarter, or unless something else happens, right? As a general rule of thumb. So technical analysis is usually the primary utilization or tool utilized by traders because you can use it on many time frames, many different stocks consistently, and you have up-to-date information. So there's a myriad of ways you can also think about your trades from a technical perspective. I just want to go back real quickly here, Troy, to, excuse me, Alta. And we'll use just a couple of super simple indicators. In fact, we'll just use one. So everything we talked about up to this point is more of like a math game, right? Like, hey, I'm going to allow $1,000 cumulative loss per one single trade. I'll allow $3 of movement per share on the trade, which means I can afford this many shares, right? And we can kind of go back and forth and figure that out. Well, a different way that we can have a what we call mechanical signal, or something that's not really math based, although you might want to work out with in math, but really just say, hey, where is my line in the sand where if this is pierced or broken or violated or crossed through, my trade is over? Super simple one is the simple moving average. Now there's many different indicators. This isn't the best one. It's not the worst one. It's just a simple one to convey. And Troy, the way that a trader might use this, and the reason I'm bringing it up, is it gives you a visual guide of when you close. or when you open. So what would be a super simple example? We'll take Ulta. If stock stays above this line, you stay in the trade. When stock closes beneath the line, you close the trade. And you might say, well, Chase, that seems overly simplistic. Does that really work? It can. It depends on the stocks you trade, the specifics of your system, the timing, the risk management that you use in addition to it. But the idea here being is we're really using the stock itself to tell us when we get in and out. It's not really a forecasting kind of thing. It's more of a reactive type approach. So let's say we entered right here, right? This first initial cross through, you say, hey, if the stock goes above, I buy it. So you buy it, things go up, then they start to come down, they come down, down, down. They're not yet quite underneath. They keep going up, and then here you would close. Well, when do you get back in? Well, when we get back above it. So we'd get back in here, would be in it, we'd be in it, we close again. So really a small loss here after a big gain. When do we get back in? Probably this candle, if not this candle. Then what happens from there? Well, pretty significant gain, probably a couple percentage points here. When do we close? Probably right about here. And the idea is we're not really trying to pick the ultimate top, the ultimate bottom. We're trying to trade with the trend. And then when the price changes trend, we change our trade with it. So I know, Troy, we spend all the time talking about technicals. We have a bunch of different sessions, I think, that are better suited for that to go through any specific example. But I just wanted to point out to clients is that you may not even look at it from a numbers and cents perspective, although you'll want to include that in your process, but that might not be the originating factor. You might actually start with the technicals and then back your way into the math and say, hey, based on this trend, the stock right now at this point in time is 10, 20 bucks from the simple moving average. So if I buy right now, if it was to get at least to this level or lower, that's $20, $30 of risk per share. Then you can work back through that formula that we just talked about, right? And again, you can do this on any stock, whether it's Ulta, Nvidia, SPY is a broader market indice, Apple, but the application would be the same as an example. Now, do you have to use the 20-day? No. That's the default our system uses. You could use the 5-day, the 200, the 50. You don't even have to use a simple moving average. The idea here, though, is you can use some form of technical criteria to help you decide when you should close. That's what we're trying to do here. In addition to that, I'll give you the final words, Troy, in just a moment. I know there's a few different questions in queue, folks. I know we're just a little bit over time. If you don't mind hanging out with us, I think it's still definitely time that's worth it. We had a question that came through from Fernando, who said, does Fidelity or saying that other brokerage companies and just the industry in general gives a target price or a forecasting price for companies? For example, Nvidia, he's saying from one source is about $1,400 per share. Is it smart to use these forecast values to guide your decisions when to sell? I know that nobody can predict the future, but what do folks do, especially if they have more knowledge? So I love this question. And funny enough, not to my own horn or the same resource, but that book I mentioned earlier, right? On the same page, there's a quote about it. Kind of makes me laugh, Troy. So I'm going to read it real quickly here. Again, this is the CMT book. It's referencing Ned Davis's book, Being Right or Making Money. And it goes on to say here that, there's two kinds of experts. And this is a quote from an economist, John Kenneth Galbraith. It says, we have two classes of forecasters, those who don't know and those who know they don't know, right? So the idea simply being it's very difficult to forecast these kinds of things. Can you use that in your process? You can. But is that going to be right sized to the stock? Does the stock market really care about those forecasts? Maybe, maybe not. How consistently can you hold yourself to them? How consistent and reliable is the forecast itself? As a more technical trader, my response would probably be use a mechanical or a technical signal to aid you in your decision-making process. And you can use those targets as maybe a best case scenario or a worst case scenario, right? So if NVIDIA, we'll go back to this example. You mentioned the author of whoever the author was of that analysis said that $1,400 was their price point, and these are typically annual year-end price targets. So if that is the case, and we zoom this out, we can kind of slide into the future here, right? Where would that put us? Well, if we assume a linear movement, which NVIDIA, of course, is not going to follow, over a year's time, we're looking at something like this, right? And then we can start to make some projections, like how reasonable is this? What if it follows this current trend up to that level? What would that trend kind of have to look like, if you will? And you can start to use a technical plan using maybe that fundamental analysis target price they gave you as a best case scenario. Should that, though, be the crux and the main thesis in construction of your trade? I think most technical traders would say absolutely not. I think most investors in general would probably say, based on their experience, probably not either. But that's not for me to say. What I will say is if you're going to consider it, don't let it be the only consideration. All right, Troy, back to you, maybe to wrap us up or final thoughts, questions that maybe stick out to you. I thought that was noteworthy though, because a lot of people out there are saying, hey, I don't know what the stock's supposed to be. Somebody tell me. But the irony is those people don't know either. And even if they do know, it doesn't mean they can force a market of billions and trillions of dollars to obey their will, at least not yet.
Yeah, Chase, again, we want to encourage people use the process, develop your own process, and use the process you're comfortable with. Use tools that you're comfortable with, especially as a beginner. This is so, so important. Folks, perhaps after having this discussion on risk, we're not going to be able to answer every single question. This is a basics class. So if this is prompting more questions, that's a good thing. You want to ask more questions. And you also have to ask yourself, okay, what's going to be useful to me in my process? So I would encourage all of you in your own time, go to fidelity.com. It's right where you log in. Take a look at your positions page. We want to have an exit strategy, but maybe you have some stocks you already own. Maybe you have some funds you already own. This is our test account, by the way. It's not a model portfolio by any means. But maybe you want to take a look. What are some positions that are working? What are some positions that are really not working? For example, we've got a security, and again, nothing against this stock, but there's a security that's going against us quite a bit. Now, again, if you look under the percentage of your count, this is your position sizing. Hey, look, this stock is only 2% of our account. So, okay, it's lost half of its value. Ouch. We probably missed the mark here. This probably was a bad trade. So you have to ask yourself, am I better off closing it and taking the current market value, which we only have 100 shares, so that's only $276. But again, in our tested portfolio, it's only $11,000 portfolio. So maybe we're better off having this in cash, putting it to work somewhere else. Maybe we want to wait it out. Maybe we want to say, all right, it came down by 50%. We bought it at $6.50. Maybe you're saying, hey, I'm going to let it ride for a little while. Maybe it doesn't have to get back to my purchase price, but maybe it'll repair a little bit and I'll have an opportunity to sell it at a more favorable loss to kind of recover some of my losses. There's different methodologies. You can use technicals, fundamentals, review some of the things that we covered today, and think about making some of these decisions. There was a question or two, hey, how do you enter trailing stop losses? There's many different ways you can trade. One popular way is right on this screen here. You could type in trade, and you can see you can enter an account. You can enter a symbol. So if I'm placing a trade, when you place, for example, an order to sell, you could say, hey, I want to sell all the shares I own. And if we use something like the expanded ticket, once you enter your quantity, we can type in order type, and you'll see here the trailing stop loss orders are built in there. We can trail by a specific dollar amount. You can trail by a percent. Again, folks, if you're saying, hey, I need to learn how to do this, some people don't even use stop orders. If you size appropriately, you might want to manually make that decision yourself as opposed to hit automatically being made if the stock goes there. Again, there's going to be different methodology, but the take home message is have a plan, have an exit strategy. Your exit strategy could look different than somebody else's, but just make sure you have some kind of thought in mind about playing defense, because if you don't play defense, you could be the best trader in the world. And if you don't manage some of your losers, you could have that one small loser that turns into a big loser and really sets you back. And that's really the take home message about what you typically want to avoid. You want to avoid the small losses that become the big losses. We want our losses to be small. We want our winners to be big. We want more winners than losers. Sounds simple, but it's not simple. And if it was simple, everybody would do it. Trading's difficult. In your own time, take a look at the Learning Center. Join us for some of our other sessions. Maybe you want to join us next month and you want to recap some of these concepts. Maybe you want to join us for another class where we talk about managing risk. Maybe you want to look at some of our other content. And there were some questions about technical indicators. We're not really going to get into this because this is a beginner class. There were a couple more advanced questions. So we have to try to keep it appropriate to the topic and the education level, if you will. So again, thanks so much, folks, for joining us. Feel free to take a look at some of our additional content. I'll be back here in 10 minutes with our aftermarket briefing. Nick and I are going to break down some of the trading trends that we saw today. We saw yields grinding higher. That's notably should be a concern for a lot of equity investors. Perhaps we're seeing a little bit of volatility following up to some of the volatility we saw last week with Nvidia's earnings. So we'd like to see you again. Thanks so much for joining us. Chase, is there anything else you'd like to add as we close here?
Hey, sorry, Troy. I know I'm coming back in after giving you the last word. I just wanted to point out again for anyone who didn't see or hear earlier how to find the recording for the session that we did today. Not today's specific session, but for a recording like it, I should mention. Again, just search Trading Basics What to Know up in the top right-hand corner of the website, and then click on the second link that will populate up to you the recording that we've done of a session like this. So if you want to recap, maybe you want to revisit an item that we didn't spend a ton of time on here today, or listen maybe to a different analogy to explain a concept, you're going to have that here with you. Recording, video, audio, and the slides available to you as well. And then just the very last thing here, Troy, I promised a client that I would show this a little bit earlier. I apologize, I didn't get to it till just now. Some people asked me earlier, multiple clients, is there a way to contact Fidelity to place a trader if I had additional questions, right? And there's a team that I used to work in called Active Trader Services. It's a customer service client facing team, but specializes in trading topics like options, order placement, the risks and maybe benefits of using one order versus another. So if push comes to shove and you go to actually place a trade, but you just can't, the website gives you an issue, you need some education on the fly that you're not going to find in the learning center easily, or you can't wait to talk to us in a session, then you can give this phone number a call. Totally free, toll free, all that stuff. It's Fidelity, you know how it is, all US based. So 877-907-4429. Again, I used to be in that department. I can definitely vouch for them. They're good folks over there. So call them if you need any immediate assistance, because of course, that's not what we're here for. We're here to help educate in sessions like this. So Troy, as always, thanks for having me along. I know I joined for week 4. This is awesome. Great engagement. Thanks everybody for choosing to spend some time here with us. We look forward to seeing you in another session. Until then, take care and be safe. Thanks, Troy. Take care.